Question 1. In California, what is the minimum free look period for a life insurance policy issued to a senior citizen, defined as age 60 or older? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. For life insurance policies issued to individuals age 60 or older in California, the free look period, also known as the right to return policy, is extended to a minimum of 30 days. This provision allows senior citizens additional time to review their policy and return it for a full refund of premiums paid if they decide it doesn't meet their needs. This extended period offers enhanced consumer protection for older applicants, ensuring they have ample opportunity to understand their significant financial commitment. Remember that for standard policies, the free look period is typically 10 days. Question 2. An individual licensed as a life-only agent in California is authorized to transact which of the following? A. Life insurance and annuities. B. Life insurance and accidental death and dismemberment policies. C. Life insurance and disability income insurance. D. Life insurance, annuities, and variable contracts. Answer: A. Life insurance and annuities. In California, a life-only agent license authorizes the agent to transact all forms of life insurance coverage, as well as all forms of annuities. This specific license covers the fundamental products within the life insurance realm, allowing agents to help clients plan for both death and retirement income through these financial vehicles. It's important to differentiate this from a life and disability analyst or a variable contracts license, which require additional qualifications or separate licensing. Question 3. Under the Incontestability Clause in a life insurance policy, after a certain period, the insurer generally cannot contest the validity of the policy due to misstatements in the application, except for what type of misstatement? A. A misstatement regarding the insured's age. B. A material misstatement of health condition. C. A non-material misstatement of occupation. D. A fraudulent misstatement. Answer: D. A fraudulent misstatement. The Incontestability Clause prevents an insurer from voiding a life insurance policy due to misstatements made in the application after the policy has been in force for a specific period, typically 2 years. However, this clause does not apply to outright fraudulent misstatements. If an applicant intentionally misrepresented a material fact with the intent to deceive, the insurer can contest the policy at any time. While age misstatements are handled by adjusting the death benefit, and material health misstatements are typically covered by the incontestability period, true fraud is an exception to the clause's protection. Always remember that fraud can unravel a contract at any point. Question 4. All of the following are typically included in a life insurance policy's entire contract provision, except A. The policy itself. B. The application. C. Any riders or endorsements. D. The agent soliciting materials. Answer: D. The agent soliciting materials. The entire contract provision states that the policy document, a copy of the application, and any attached riders or endorsements constitute the complete agreement between the policy owner and the insurer. This provision is crucial because it ensures that no statements made outside of these documents, such as oral promises by an agent or promotional brochures, soliciting materials, can be used to alter or contradict the policy's terms. This protects both parties by clearly defining the boundaries of the agreement. Question 5. Which of the following statements about the waiver of premium rider is most accurate? A. It pays a monthly income directly to the insured if they become disabled. B. It waives the policy's cash value surrender charges if the insured becomes disabled. C. It pays the premiums for the policy if the insured becomes totally and permanently disabled. D. It allows the insured to skip premium payments for a limited time after policy issue. Answer: C. It pays the premiums for the policy if the insured becomes totally and permanently disabled. The waiver of premium rider is a valuable benefit that ensures the life insurance policy remains in force even if the insured becomes totally and permanently disabled and unable to pay premiums. Instead of the insured paying, the insurance company will cover the premiums until the insured recovers or reaches a certain age, or the policy matures. This rider provides crucial protection against policy lapse due to an unforeseen disability, preserving the death benefit for the beneficiaries. Think of it as an insurance policy for your insurance premiums. Question 6. A life insurance policy that offers flexible premiums, flexible death benefits, and cash value accumulation that grows based on the performance of a separate account, which the policy owner directs, is known as A. Adjustable life. B. Whole life. C. Universal life. D. Variable universal life. Answer: D. Variable universal life. Variable universal life, VUL, insurance offers the flexibility of universal life policies, such as adjustable premiums and death benefits, combined with the investment control features of variable life. The key distinguishing characteristic is that the cash value accumulates in a separate account, with the policy owner typically directing how the funds are invested in various subaccounts, like mutual funds. Because the cash value growth is tied to market performance and involves investment risk, VUL policies are considered securities and require a FINRA Series 6 or 7 license in addition to a state life insurance license. Question 7. What is the primary purpose of the California Financial Solvency Standards Board, FSSB? A. To regulate premium rates for life insurance policies. B. To oversee the financial condition of insurance companies doing business in California. C. To investigate consumer complaints against insurance agents. D. To administer the California Life and Health Insurance Guarantee Association. Answer: B. To oversee the financial condition of insurance companies doing business in California. The California Financial Solvency Standards Board, FSSB, is responsible for developing and proposing solvency standards for insurance companies operating in the state to ensure they remain financially sound and able to meet their obligations to policyholders. While the Department of Insurance, DOI, enforces these standards, the FSSB's role is specifically to recommend standards related to capital, reserves, and other financial aspects. This helps protect consumers by reducing the risk of an insurer becoming insolvent. Question 8. In a group life insurance policy, what is the term for the document issued to each insured employee that summarizes the coverage? A. Master policy. B. Certificate of insurance. C. Individual policy. D. Schedule of benefits. Answer: B. Certificate of insurance. In a group life insurance arrangement, the employer or association holds the master policy that outlines the terms of coverage for the entire group. Each individual employee or member who is covered under this master policy does not receive a separate individual policy but instead receives a certificate of insurance. This certificate serves as evidence of their coverage, detailing key information such as the amount of coverage, the designated beneficiaries, and the policy's effective date. Question 9. Which of the following statements regarding the taxation of the death benefit from a life insurance policy is generally true? A. Death benefits are typically taxable as ordinary income to the beneficiary. B. Death benefits are generally received income tax-free by the beneficiary. C. Death benefits are always subject to federal estate taxes. D. Death benefits are taxable if they exceed the premiums paid into the policy. Answer: B. Death benefits are generally received income tax-free by the beneficiary. One of the most significant tax advantages of life insurance is that the death benefit paid to a named beneficiary is generally received free of federal income tax. This means the full face amount of the policy is available to the beneficiaries to use as needed without being reduced by income taxes. While death benefits might be included in the deceased's gross estate for federal estate tax purposes if the insured retained incidents of ownership, they are typically not subject to income tax for the beneficiary. This tax-free payout is a core benefit of life insurance. Question 10. All of the following are common settlement options for life insurance policy proceeds, except A. Lump sum. B. Interest only. C. Fixed period. D. Extended term. Answer: D. Extended term. The extended term option is a non-forfeiture option, which dictates how the policy's cash value is used if the policy owner stops paying premiums. It is not a settlement option for how death benefits are paid out. Common settlement options for death benefits include lump sum, a single payment, interest only, the insurer holds the proceeds and pays interest to the beneficiary, and fixed period, payments made over a specified period. Remember, settlement options are about how the death benefit is distributed, while non-forfeiture options are about how cash value is used when a policy lapses. Question 11. An agent who, after a policy has been in force for a period of time, persuades a policy owner to surrender an existing policy and purchase a new one to the policy owner's detriment, is engaging in which illegal practice? A. Rebating. B. Churning. C. Twisting. D. Coercion. Answer: C. Twisting. Twisting occurs when an agent makes misleading statements or comparisons to induce a policy owner to lapse, forfeit, or surrender an existing life insurance policy and replace it with a new one to the policy owner's disadvantage. This practice is illegal because it often results in the policy owner losing valuable benefits from the old policy and incurring new costs or waiting periods with the new policy. Churning is similar but specifically involves an agent unnecessarily replacing policies within the same company for the purpose of generating new commissions. Question 12. Which of the following is a characteristic of a participating life insurance policy? A. It has a fluctuating premium based on market performance. B. It pays dividends to the policy owner, which are a return of unused premium. C. It is sold primarily by stock insurance companies. D. Its cash value is invested in a separate account. Answer: B. It pays dividends to the policy owner, which are a return of unused premium. A participating life insurance policy, typically issued by mutual insurance companies, allows the policy owner to participate in the company's divisible surplus. This participation comes in the form of policy dividends, which are essentially a return of a portion of the premium paid if the company's experience, example mortality, expenses, investments, is more favorable than anticipated. Dividends are not guaranteed, but when paid, they are generally not taxable as income, as they are considered a return of an overcharge rather than a gain. Question 13. Which rider would provide an additional death benefit if the insured dies as a direct result of an accident? A. Waiver of premium rider. B. Guaranteed insurability rider. C. Accidental death benefit rider. D. Cost of living adjustment rider. Answer: C. Accidental death benefit rider. The accidental death benefit rider, often called a double indemnity rider, provides an additional payout, usually double the face amount of the policy, if the insured's death is caused directly by an accident, subject to specific policy conditions and exclusions. This rider is designed to provide extra financial protection to beneficiaries in the event of an unexpected and tragic accidental death. It's an optional add-on that enhances the policy's payout under specific circumstances. Question 14. What is the purpose of the California Life and Health Insurance Guarantee Association, CLIGA? A. To protect policy owners in case an insurer becomes insolvent. B. To set premium rates for life and health insurance in California. C. To license and regulate insurance agents in California. D. To resolve disputes between insurers and policy owners. Answer: A. To protect policy owners in case an insurer becomes insolvent. The California Life and Health Insurance Guarantee Association, CLIGA, is a state-mandated organization that protects policy owners, insureds, and beneficiaries of life and health insurance policies when an insurance company becomes financially impaired and cannot meet its obligations. CLIGA steps in to provide coverage limits for eligible policies, ensuring that even if an insurer fails, policyholders do not lose all their benefits. This provides a crucial safety net for consumers, similar to how the FDIC protects bank deposits. Question 15. The right of an individual to transfer ownership of a life insurance policy to another person is known as A. Beneficiary designation. B. Policy loan. C. Assignment. D. Surrender. Answer: C. Assignment. Assignment refers to the transfer of ownership rights of a life insurance policy from the current policy owner to another person or entity. This can be either an absolute assignment, transferring all rights permanently, or a collateral assignment, transferring rights as security for a loan, with rights reverting to the original owner once the loan is repaid. It's a common practice for business loans or estate planning, allowing the policy's value or future benefits to be used as collateral or for other purposes. Question 16. If a policy owner stops paying premiums on a whole life policy and selects the reduced paid-up non-forfeiture option, what happens to the policy's death benefit? A. The death benefit remains the same, but the policy will lapse after a fixed period. B. The death benefit is converted to term insurance for a specified period. C. The death benefit is reduced to a smaller, fully paid-up amount. D. The policy's cash value is paid out as a lump sum. Answer: C. The death benefit is reduced to a smaller, fully paid-up amount. When a policy owner chooses the reduced paid-up non-forfeiture option, the existing cash value of the whole life policy is used as a single premium to purchase a new, smaller paid-up whole life policy. This new policy will have a reduced death benefit compared to the original, but it will remain in force for the remainder of the insured's life without any further premium payments required. It's a way to maintain some level of permanent coverage without incurring future premium obligations. Question 17. Which statement accurately describes a characteristic of term life insurance? A. It builds cash value over time. B. It provides coverage for a specific period of time. C. Its premiums remain level throughout the insured's life. D. It provides a loan feature against its accumulated value. Answer: B. It provides coverage for a specific period of time. Term life insurance is characterized by providing coverage for a defined period, or term, such as 10, 20, or 30 years. If the insured dies within that term, the death benefit is paid to the beneficiaries. If the insured outlives the term, the policy expires, and no death benefit is paid. Unlike permanent life insurance, term policies do not build cash value, offer loan features, or typically maintain level premiums beyond the initial term. It's pure protection for a temporary need. Question 18. What is the standard grace period for individual life insurance policies in California? A. 10 days. B. 20 days. C. 30 days. D. 31 days. Answer: D. 31 days. In California, the standard grace period for individual life insurance policies is 31 days. This provision allows the policy owner an additional 31 days beyond the premium due date to pay the premium without the policy lapsing. If the insured dies during this grace period, the death benefit will still be paid, minus any overdue premium. This essential clause provides a safety net, preventing accidental policy lapse due to a slight delay in payment. Question 19. An agent's license in California may be involuntarily inactive if the agent fails to A. Renew their errors and omissions insurance. B. Complete their continuing education requirements. C. Join an industry trade association. D. Achieve a certain sales quota. Answer: B. complete their continuing education requirements. In California, agents are required to complete a certain number of continuing education (CE) hours prior to their license renewal date. Failure to fulfill these CE requirements will result in the agent's license becoming involuntarily inactive, meaning they cannot legally transact insurance business until the requirements are met and the license is reactivated. This ensures that agents stay current with industry changes and regulatory updates. Question 20. When an insurer uses HIV/AIDS testing in California during the underwriting process, what is required? A. The insurer must always approve the policy regardless of the test results. B. The applicant must give written consent for the test. C. The test results must be disclosed to the applicant's employer. D. The insurer must pay for the applicant's follow-up medical treatment if the test is positive. Answer: B. The applicant must give written consent for the test. In California, if an insurer requires an applicant to undergo HIV/AIDS testing as part of the underwriting process, the applicant must provide specific written consent prior to the test. This ensures the applicant is fully aware of and agrees to the testing. Strict confidentiality rules also apply to the results, protecting the applicant's privacy. This consent protects consumer rights while allowing insurers to properly assess risk. Question 21. Which annuity payout option guarantees payments for the entire lifetime of the annuitant, but stops payments upon the annuitant's death? A. Life annuity with period certain. B. Joint and survivor annuity. C. Refund life annuity. D. Straight life annuity. Answer: D. Straight life annuity. A straight life annuity, also known as a pure life annuity, provides the highest possible periodic income payments to the annuitant for as long as they live. However, it offers no guarantees for beneficiaries. Payments cease entirely upon the annuitant's death, regardless of how soon that occurs after annuitization. This option maximizes income for the annuitant but carries the risk of forfeiture if the annuitant dies early. Question 22. What is the primary purpose of the replacement regulations in California? A. To prevent all instances of policy replacement. B. To ensure that replacing an existing policy is always in the policy owner's best interest. C. To protect consumers from potential financial detriment when replacing an existing life insurance or annuity policy. D. To simplify the application process for new life insurance policies. Answer: C. To protect consumers from potential financial detriment when replacing an existing life insurance or annuity policy. California's replacement regulations are designed to protect consumers by ensuring that they are fully informed about the potential consequences of replacing an existing life insurance policy or annuity with a new one. The regulations require specific disclosures and procedures to be followed, such as providing a notice regarding replacement and comparing the features of the existing policy with the proposed new one. This helps prevent consumers from losing valuable benefits, incurring new fees, or facing new waiting periods without understanding the implications. Question 23. An applicant for a life insurance policy is referred to as the insured once the policy is issued. Who is the owner of the policy? A. The person whose life is covered by the policy. B. The person who pays the premiums and has the rights in the policy. C. The beneficiary designated to receive the death benefit. D. The insurance company that issues the policy. Answer: B. The person who pays the premiums and has the rights in the policy. The owner of a life insurance policy is the individual or entity who possesses all the contractual rights within the policy, such as the right to pay premiums, designate beneficiaries, take out policy loans, surrender the policy, or make changes to the policy. While the insured is the person whose life is covered and the beneficiary receives the death benefit, the owner holds the control. Often, the owner and the insured are the same person, but they can be different, especially in business or estate planning contexts. Question 24. All of the following are typically considered incidents of ownership in a life insurance policy for federal estate tax purposes, except A. The right to change the beneficiary. B. The right to surrender or cancel the policy. C. The right to assign the policy or pledge it as collateral. D. The right to receive the death benefit as the beneficiary. Answer: D. The right to receive the death benefit as the beneficiary. Incidents of ownership refer to the economic rights in a life insurance policy that would cause the policy's proceeds to be included in the insured's gross estate for federal estate tax purposes. These rights include the ability to change beneficiaries, surrender or cancel the policy, make policy loans, or assign the policy. However, merely being the beneficiary who receives the death benefit is not an incident of ownership that would cause the proceeds to be included in the insured's estate. Question 25. An agent who issues a binder for life insurance coverage in California is generally doing what? A. Providing temporary evidence of coverage until the policy is issued. B. Guaranteeing that the policy will be issued as applied for. C. Collecting the first premium payment. D. Renewing an existing life insurance policy. Answer: A. Providing temporary evidence of coverage until the policy is issued. While common in property and casualty insurance, in life insurance, a binder as a promise of temporary coverage is rare and often refers to a conditional receipt. A conditional receipt provides immediate, temporary coverage if the applicant pays the first premium and typically if the applicant is found to be insurable according to the insurer's underwriting rules. It's a critical tool because it bridges the gap between application and policy issuance, providing protection during that period, but does not guarantee the policy will ultimately be issued.